There are thousands of indicators available to modern traders. So which are the best? The best technical tools are user-friendly and intuitive. Easy is almost always better. This concept is certainly true with moving averages. Now, when you choose a moving average, you need to keep in mind that there is no need to get bogged down in the more advanced MAs. The whole moving average or the adaptive moving average, these are elegant indicators. But are they truly right for you? Are they the best fit? Maybe, maybe not. Now, in this video, we're going to take away all the guesswork. We're going to cover the top two moving averages, the simple moving average and the exponential moving average.
The key to being profitable in the markets is consistency. And all consistent traders have one thing in common. They understand their approach to the markets. No matter what tools and indicators are being used, profitable traders know exactly what they are doing. Enter the simple moving average. The simple moving average is the gold standard of moving averages because it is easy to use. As we said earlier, simple is often better. To calculate the SMA, you merely add up the price for X number of periods and then divide by that number of periods. Here's an example. Assume that we are calculating a 7-day moving average for the closing values of the Dow Jones Industrial Average. All we need to do is add up each closing price and then divide by 7. We now have our current SMA value for the Dow. Now I have some great news for you. You don't need to do this by hand. Our trading platforms do all the work for us automatically, and they plot it via a line on our pricing chart. Compared to the simple moving average, the exponential moving average, or EMA, is much more complex. Honestly, there's no reason to get bogged down in the minutia of the EMA calculation. After all, we're traders, not mathematicians. Just like with the SMA, our platform will do all the heavy lifting for us. But it is important to understand the concept behind the EMA. Okay, forget the math. Here's what you need to know about EMAs. The EMA shifts the weight of the moving average calculation to the more current periods. This ensures that the average moves quickly and represents the most recent price action. Because of this dynamic, the EMA signals trends or reversals faster than other moving averages. Now for the big question. Which MA is right for you, the SMA or the EMA? Well, there are no rules for choosing a moving average, but here are 2 tips for making your moving average the best that it can be. Number 1, your trading style will dictate which type of moving average is best for you. If you're a short-term intraday trader who relies on speed, then the EMA is your ideal choice. Why? Because the EMA is more sensitive to recent price movements. On the other hand, if you're a swing trader who depends on reliability, then the simple moving average may be a better choice. Why? Because the SMA gives you a broad, balanced representation of a market's price action. Now here's the second tip. You don't have to use just one MA. You can incorporate multiple moving averages into your trading strategy. For instance, a common day trading strategy utilizes a 5-8-13 combination of SMAs or EMAs to discern market state and to place trades. Swing traders are known to focus on the 20, the 50, and 100 period SMAs or EMAs to trade. And long-term investors frequently reference the 50 and 200 period SMAs to take positions in the market. The point is this. There are no rules for selecting a moving average or moving averages. The choice is yours. Feel free to experiment with different types, durations, and numbers of moving averages. Also, adding other indicators to your moving average analysis is perfectly fine. The key is to be consistent with your analytics. Lastly, remember this rule of thumb. EMAs are fast and SMAs are slow. Each has its place. Just be sure that you apply each within the context of your comprehensive trading plan. Do that, and these EMAs can take your trading to the next level.